The biggest mortgage collapse in U.S. history has entered a volatile third phase, signaling a 2026 housing market crash unlike anything seen in 2008. While many focus on residential shifts, office loan delinquencies have hit a record 12.34%, officially surpassing the peak of the Great Recession. Economic stability is fracturing. The U.S. recently lost 92,000 jobs in February, marking the third decline in 5 months. Consumer sentiment has plummeted to 55.5, a 50-year low for the start of a recession. Despite the Fed cutting rates 6 times, mortgage rates spiked back above 6.2% due to global conflict, erasing the brief relief homeowners felt. We're breaking down the hidden data nobody else is discussing. Before we get started, make sure you're subscribed to Housing Watch and turn on notifications so you don't miss what's coming next. Your support really helps the channel grow. Number 1, we're going to show you the specific data on how the housing market is now fracturing into 2 completely separate economies. Markets like Hartford and Kansas City are hitting all-time highs, while Austin, Tampa, and Florida condos are in free fall. And we're going to show you the data that explains exactly why this is happening and which side you want to be on. Number 2, we're going to show you why the commercial real estate debt wall that we warned you about is no longer a future threat. Nearly 2,000 banks are sitting on dangerous levels of exposure, and the FDIC just stopped disclosing how bad the problem actually is. And number 3, we're going to explain what Phase 3 actually means, why it's called the fracture, and why the decisions you make in the next 6 to 12 months could save you or cost you tens of thousands of dollars. So, let's get into it. All right, everyone, let's start with the macro picture because this is what set the stage for Phase 3. In our last 2 videos on Phase 2, I told you about forced selling, the lock-in effect fading, negative equity spreading, the Fed's rate cuts not working. All of that is still happening, but something new has entered the equation. The job market has broken. Non-farm payrolls fell 92,000 in February 2026, third negative print in 5 months. December was revised to a loss of 17,000. When you average it out, the U.S. is creating just 13,000 jobs per month over the last 12 months. That is essentially zero. Federal government employment alone is down 330,000 positions. Long-term unemployment has climbed to 1.9 million people, and labor force participation dropped to 62%. Its lowest since December 2021. Now, here's why this matters so much for housing. In Phase 2, mortgage delinquencies were manageable because people still had income. When you lose your job, a delinquency becomes a foreclosure, and there are already 850,000 borrowers who are 90-plus days delinquent or an active foreclosure right now. That is the largest volume since July 2022. Those are the people on the edge, and the job market just pushed them closer. And the Fed stuck. They held rates at 3.5% to 3.75% at the March 18th meeting, second consecutive hold. Inflation is still running at 2.7% PCE, revised upward from December. The dot plot shows only one additional cut expected for the rest of 2026, with markets not pricing the next move until September. And here's the full picture on those mortgage rates I mentioned at the top. They briefly touched 5.98% in late February, the first sub-6% reading since 2022. For about 2 weeks, it looked like buyers might finally catch a break. Then the U.S.-Israeli military conflict with Iran began on February 28th. Oil prices spiked, Treasury yields jumped, and within 2 weeks, the 30-year went from 5.98% back to 6.22%. The narrowest window of affordability relief we've had in 4 years. And it's already gone. The consumer is getting hit from every direction. Michigan sentiment is the second percentile of its entire history. Personal savings dropped to 3.6%. Household debt hit a record $18.8 trillion. Bankruptcy filings rose 14% year over year, with commercial Chapter 11 filings surging 67%. This is the macro backdrop for Phase 3. The Fed is paralyzed. The job market is contracting. The consumer is tapped out. And a geopolitical shock just reversed the one thing: lower rates that could have helped. Now, real quick before I get into the fracture data, this market is moving fast. Like, sub-6% mortgage rates appeared for 2 weeks and vanished fast. If you're relying on the algorithm to show you our videos, you're seeing this stuff days late. And in this market, days matter. Hit the notification bell right now so you're the first to know when we drop new data. Not the last person finding out after the opportunity already passed. Now, let me get into the first thing we promised you at the top, because this is what defines Phase 3. The housing market is fractured into two completely separate economies. On the surface, the national numbers still look okay. The median existing home price hit $398,000 in February, 32nd consecutive month of year-over-year gains. But that headline number is hiding a massive divergence. The Case-Shiller National Index gained just 1.3% nominally in all of 2025, the weakest annual appreciation since 2011. When you adjust for inflation, real home prices have been declining for 4 consecutive months. New home prices are falling outright, down 6.8% year over year to $400,500. Builders are slashing prices, and we're going to get into those numbers in a minute. But here's where the fracture becomes really clear. On one side, markets in active decline. Tampa's Case-Shiller Index has fallen for 13 consecutive months, down 3.9%. Florida condo prices are down 6.1% statewide, with 92% of major condo markets declining. And we need to tell you why, because the Florida condo situation is the clearest example of Phase 3 in action. After the Surfside building collapse, Florida mandated structural inspections for aging buildings. The result? 40% of condo owners have faced special assessments in the last 3 years. Some builders are levying $134,000 to $400,000 per unit. Combine that with homeowners' insurance averaging $7,500 to $14,000 annually, 181% above the national average, and you have owners who aren't choosing to sell. They're being forced to liquidate. That is Phase 3. Austin listings carry price reductions 48.9% of the time. Dallas is down 4.1%. Denver is down 3.6%, with luxury-attached homes sitting at 26 months of supply. Phoenix remains 7% below its 2022 peak, with 63% of listings showing price cuts. On the other side, markets hitting all-time highs. Hartford, Zillow's #1 market for 2026, has inventory 63 to 74% below pre-pandemic levels, with only 16.5% of homes seeing price cuts. Boston was named the hottest large metro. Kansas City prices rose 5.2%. Toledo is forecast for 13.1% growth. Now, in our Phase 2 video, we warned you about the Northeast and Midwest becoming overvalued while losing population. We still believe that risk is real over 12 to 18 months, but the migration data has shifted in a way we didn't expect. The entire Midwest region recorded positive net domestic migration for the first time this decade. Ohio went from losing 32,000 domestic migrants in 2021 to gaining nearly 12,000. Michigan completed a similar turnaround. People are leaving the overpriced Sun Belt and moving to affordable markets. Meanwhile, Florida went from 310,000 net domestic movers in 2022 to just 22,000 in 2025, a 93% collapse. Tampa's inflow dropped 70% in a single year. Orlando's nearly vanished. United Van Lines classified both Florida and Texas as balanced for the first time, and Miami-Dade County posted the worst domestic outflow among high flood risk counties at over 67,000 people leaving. Affordability-seeking migrants are leaving the Sun Belt and flowing into the Midwest. Price support in the cheap markets. Price erosion in the expensive ones. Two Americas, two housing markets. That is the fracture. Now, let's talk about negative equity and foreclosures, because these numbers have gotten worse since Phase 2. Negative equity has grown to 1.2 million homes, up 15% year over year. 2.1% of all mortgages are now underwater, up from 1.3% just 1 year ago. FHA delinquency is running at 11.52%, up 74 basis points in a single quarter. FHA now accounts for more than half of all serious delinquencies nationally, despite being a fraction of the total market. Foreclosures have risen for 12 consecutive months. Intercontinental Exchange recorded 42,000 foreclosure starts in January, the highest monthly total since early 2020. Completed foreclosures rose 35% year over year in February. The states leading in distress are Florida, Texas, Indiana, and South Carolina. These levels are still well below 2008 peaks, when 23% of mortgages were underwater versus 2.2% today. But as I told you in Phase 2, it always starts as a drip. The question is the trajectory, and the trajectory is clearly accelerating. Okay, side note, I know we just threw about 47 statistics at you in the last 3 minutes. That's exactly why we do these every week, so you don't have to spend your Saturday night reading Intercontinental Exchange Mortgage Monitor reports. Although honestly, if that is your Saturday night, we should be friends. Hit the bell so YouTube actually sends you these breakdowns the moment they go live. We genuinely believe that people who follow this data closely are going to come out of this cycle way ahead. Now, let me get into the second thing I promised you, the commercial real estate debt wall. This is no longer a future threat. It is happening right now. Office CMBS delinquency hit an all-time record of 12.34% in January 2026. An all-time record worse than 2008 surpassed the post-financial crisis peak by 1.6 percentage points, and multifamily CMBS delinquency surged 239 basis points year over year to 6.85%. 85%, the largest increase of any sector. Multifamily was supposed to be the safe CRE asset class. It's not safe anymore. Between $875 billion and $936 billion in CRE loans mature in 2026 and 18.8% jump over 2025. And last year's experience tells you what's coming. Of roughly $957 billion maturing in 2025, only 50 to 55% were actually paid off. The rest were extended, modified, or defaulted. Distressed CRE assets reached $116 billion, up 31% year over year. And here's why this matters for residential housing: the banking system. 1,788 banks, over a third of all U.S. banks, carry CRE exposure, exceeding 300% of their total equity capital. Of those, 504 exceed 500%. S&P Global Projects. Bank loan loss provisions could rise to 24% of net revenue in 2026. Two banks already failed in 2025 from CRE stress, and the FDIC stopped disclosing total assets on the problem bank list in February 2025. They reduced transparency at precisely the moment it matters most. Now, let me talk about the builders, because they're providing the clearest price signal in the market right now. New home sales plunged 17.6% in January to 587,000, the lowest pace since November 2022. Inventory stands at 9.7 months of supply, well into buyer's market territory. Builder confidence has been below 50 for 23 consecutive months, and the concession war is getting aggressive. 37% of builders are cutting prices. 64% are offering sales incentives. Lenders' incentives now average 13.3% of the sales price. Roughly $60,000 on a $450,000 home versus a normal 5 to 6%. Pult Group's per-sale incentives more than doubled to over $52,000. D.R. Horton is sitting at 7,300 completed but unsold homes and offering 3.99% FHA rate buydowns. This is important for existing home sellers to understand. You are not just competing with other sellers anymore. You're competing with builders who are willing to give away $50 to $60,000 in concessions. If you're listing a resale home in a Sunbelt market and you're not pricing aggressively, the builders are eating your lunch. So, let me tie this all together and explain what Phase 3 actually means. Phase 1 was the freeze. 2023 through most of 2025, buyers and sellers both stopped transacting. Prices stayed elevated because there was no inventory. Phase 2 was forced selling. Late 2025 into early 2026, the lock-in effect faded. Negative equity spread. Foreclosures accelerated. Price cuts became the norm in Sunbelt markets. Phase 3 is the fracture. It's fundamentally different because it's not uniform. The market has split apart along three fault lines. The first is geographic. Sunbelt markets are in active decline, while Midwest and Northeast markets are appreciating. Two Americas, two housing markets. The second is demographic. FHA borrowers are at 11.52% delinquency, while conventional borrowers sit at 2.89%. The bottom half of the market is deteriorating while the top half holds, and the government is making things worse. FHFA just lowered the GSE affordable housing goals, cutting support for exactly the population where distress is most concentrated. The third is property type. Single-family is outperforming condos. Office CRE is at record distress while industrial thrives. New construction is being liquidated through concessions while existing homes in tight markets hold firm. And here's what makes Phase 3 dangerous. Each of these fractures is self-reinforcing. Falling Sunbelt prices push more borrowers underwater, which leads to more foreclosures, which pushes prices down further, which reduces migration, which removes demand, which pushes prices down even more. The job losses are adding fuel to every one of these cycles, and the geopolitical shock has removed the one tool, lower rates, that could have slowed the deterioration. But let me be clear, I'm not saying every market in America is crashing. If you're in Hartford, Rochester, Kansas City, or Boston, your market is supply-constrained and appreciating. The fracture means some markets are in serious trouble, while others are doing just fine. The national average hides both realities. So, what does this mean for you? If you're a seller in a declining market, the builders are your biggest competition, and they're giving away tens of thousands in concessions. Every month you wait is likely a lower price. Austin sellers who waited have lost 27.8% since 2022. Price to the market today, not the market you wish you had. If you're a buyer in a declining market, you have leverage you haven't had in years. 62% of buyers are paying below list price with an average discount of 7.9%, the largest since 2012. Builders are offering rate buydowns and $50,000 plus in concessions. Be patient, negotiate hard, and let the data guide you. If you're in a supply-constrained market, be careful about overpaying. The same migration patterns helping the Midwest today were helping the Sun Belt 3 years ago. And if you own a Florida condo, especially in a building approaching its 30-year inspection deadline, you need to understand your exposure to special assessments and insurance costs right now, not next year. Now, we are in Phase 3. The market has fractured. And honestly, this is the part of the cycle where the difference between being informed and guessing becomes tens of thousands of dollars. We're going to be covering every twist and turn as this plays out. New data drops, Fed decisions, foreclosure waves, all of it. If that bell isn't on, YouTube is going to bury this in your feed somewhere between a cat video and a guy pressure washing a driveway. Don't let the algorithm decide when you find out about the next phase. Hit the bell. Drop a comment telling us what market you're watching.